And in our top business story, with the current global economic climate coupled with lower hydrocarbon prices, fiscal budgets for sustainable development of the countries in the MENA region was in top focus during the 7th annual meeting of the Organization for Economic Cooperation Development Senior Budget Officials being held in Abu Dhabi. With the price of crude oil falling to 5-year lows, the officials gathered at the OECD meeting have called for more focus on contingency plans for sustaining the government expenditures, particularly for the oil-producing countries in the region. More than 70 representatives from 15 OECD member countries of the MENA region are taking part in the 2-day meeting, together with experts from World Bank and International Monetary Fund to share best practices for managing fiscal budgets. According to the chairman of Department of Finance of Abu Dhabi, who had delivered the opening speech of the conference, the GCC nations in particular face fiscal policy challenges and should diversify into non-oil sectors by reducing their reliance of hydrocarbon-related revenues. The meeting was co-chaired by Swedish Ministry of Finance's Director of Budget Department, who stated that contingency plans for difficult macroeconomic conditions should also be taken into account when allocating federal budgets. Among the discussions that will be held over the next few sessions of the meeting include investments and public financial management in key sectors such as infrastructure, energy subsidies, education and healthcare, which play a key role in ensuring sustainable development.
In many countries that have medium-term budget frameworks, there's the issue of how to square the short budget decisions with long-term projects that have benefits in the very long term, but that may be uncertain benefits versus the short-run costs of these programs. So infrastructure is one of the topics that's going to be discussed. Energy subsidies is also a topic, and that's I think many countries share this issue of how to handle them. It's an ongoing progress. I mean, sometimes events are slow moving, but for example now, I mean, we know that oil prices are going down, and that can put a strain on existing systems, and the strain can come faster than we think. And therefore it's important to discuss how to deal with it now, but also to think about other possibilities that can happen. One has to have a contingency plan and to be able to deal with unexpected events, and also to see, I mean, how do you finance your core government programs, I mean, healthcare, education, so that they're not unduly affected by fluctuations that are outside the direct control of most countries.
The UAE, which has the highest rating in the GCC along with Kuwait and Qatar, has been ranked at very high by Moody's in terms of fiscal strength, reflecting the sound capacity of the government to mobilize resources to repay its debt. The global ratings agency said in its latest credit analysis that such a high score is shared only by countries including Luxembourg, Hong Kong and Switzerland. The Moody's Investor Service report said that the outlook on the UAE's AA2 foreign and local currency government issuer ratings has been stable since it was upgraded by one notch in 2007. The UAE's ranking is supported by large consolidated fiscal surpluses, a moderate level of consolidated direct government debt and the public sector's sizable stock of offshore assets, mainly held by Abu Dhabi. Moody's added that it expects lower oil prices to considerably reduce the surplus this year, but not dent overall fiscal strength. The Habtoor Group has unveiled 3 new mega projects in Dubai worth 2.01 billion dirhams at a press conference on Tuesday. Khalaf Ahmad Habtoor, the founder and chairman of the group, confirmed that work is already underway for the 993 million dirham Habtoor Polo Resort and Club, the Metropolitan Sheikh Zayed Road and Oasis Villas, costing 1.02 billion dirhams, all of which are expected to be operational in the coming 2 years. The 6 million square foot Habtoor Polo Resort and Club will include a 5-star hotel with up to 136 keys, in addition to 162 luxury bungalows, a polo club, a state-of-the-art polo academy and a riding school with 500 stables. The Metropolitan Sheikh Zayed Road is a revival of the company's first iconic hotel business that had opened in 1979. The new Metropolitan is a 4-star boutique hotel with 334 rooms and will also incorporate many dining, business and leisure facilities, in addition to the revival of the Red Lion traditional English pub that closed along with the original Metropolitan. Expanding on its real estate business, the Al Habtoor Group is building Oasis Villas, a residential development alongside the Metropolitan Sheikh Zayed Road. During the announcement, Al Habtoor also spoke about the group's financial performance. In the past 3 years, he stated that total revenue was 37% with an average annual revenue growth rate of 12.5%. Total net worth over the same period jumped 20% with an average annual net worth growth rate of nearly 7%. The chairman added that the next 5 years are expected to see revenue growth jump to 161%, which would equal to an average annual growth of 32%. And New Scotland Yard, the headquarters of the Met Police in London, has been sold to Abu Dhabi Financial Group for £370 million. The Abu Dhabi investment company paid £120 million, more than the asking price for the 1960s block, and plans a development of luxury flats on the site overlooking Westminster Abbey. Marketed as 10 Broadway, the 1.7-acre, 600,000 square foot building attracted intense interest, with 11 credible bids from around the world. ADFG, a multi-billion-dollar alternative investment company based in Abu Dhabi, secured the deal with a track record of financing major central London developments, including the One Palace Street project adjacent to Buckingham Palace, for which ADFG plans to create a mixed-use residential development on the site. The sale is part of an ongoing radical overhaul of the Met estate, which has so far raised £215 million through the sale of 52 underused and outdated buildings.